Global markets have taken on a much more upbeat outlook over the last month. The S&P 500 index, for instance, was up 18% in April, its largest monthly rise since 1987. Tech-heavy Nasdaq rose 21% last month, while the Russell 2000 index, which captures smaller American companies, rose by 23%. Now, there have been a number of factors behind the sharp improvement in equity markets around the world. Several countries have announced partial reopenings in May. COVID curves have also flattened in many countries. Gilead Sciences, the maker of Remdesivir, stated it had seen positive results in a US study too. Oil markets cheered some signs that the pace of inventory increase may be slowing, and some commodity markets, such as copper, which tends to be seen as an important barometer of the global economy, hit 6-week highs. This much more upbeat view flew in the face of some truly shocking data, however. US growth contracted by a larger than expected 4.8% in Q1 in annualized terms. Much worse is still to come, though, with Q2 contraction forecast at minus 26%, again in annualized terms, meaning the US has plunged into a vicious recession. Meanwhile, France confirmed the fastest drop in economic activity since records began in 1949. The 5.8% contraction in Q1 from the previous quarter followed a modest 0.1% contraction in Q4, so France was already in a recession even before COVID struck. However, the most shocking single piece of data has to be initial jobless filings in the US. Another 3.8 million Americans filed claims for unemployment benefits last week, bringing the 6-week total since the start of the lockdowns to more than 30 million workers. It took the US economy almost 10 years from the end of the global financial crisis to create a net 21 million jobs. It's taken just 6 weeks to destroy 30 million jobs, meaning that unemployment will head above 20% and beyond in coming months. The FOMC statement this week was very clear about the considerable risks to the economic outlook over the medium term, and Chair Powell noted in Q&A that we're committed to using our full range of tools to support the economy in this challenging time. We're going to use them forcefully, proactively, and aggressively until we're confident that we're solidly on the road to recovery. Our sense is that the aggression behind the Fed's move has been a major driver of the improved sentiment in global markets. The Fed's balance sheet has been propelled from less than $4 trillion before COVID-19 hit the US to around $6.5 trillion currently. That's an increase of $2.5 trillion, more than the combined QE1 and QE2 programs the Fed executed between Q3 2008 and Q3 2011. And given the Fed's balance sheet is likely on its way to between 8 and 10 trillion, the current action could be larger than QE1, 2, and 3 combined. The speed with which the Fed has executed this move has also added to optimism in markets. Over the last 8 weeks, securities on the Fed's balance sheet have increased by 1.6 trillion US dollars. That's 4 times the fastest pace of increase that we've ever seen from the Fed. Now, the idea that the Fed could become even more proactive and aggressive has certainly helped offset the horrible data that has started to be released around the world. While the improved tone has extended to some commodities, including copper up 5% in April, the commodities Australia specialises in exporting have not fared as well. Thermal coal has lost 1/5 of its value in April. Met coal used in blast furnaces lost 1/4 of its value in April. Asian liquid natural gas prices have dropped to fresh record lows. And while iron ore prices have held up better, the weakness in commodities that Australia specialises in exporting certainly calls into question the strength of the Australian dollar. Indeed, the Australian dollar was the strongest G10 currency in April by a significant margin, with the New Zealand dollar a distant second. So is this move justified? We would certainly argue that the speed with which COVID curves have flattened in Australia and New Zealand have helped sentiment, and with both countries moving towards removing some restrictions, that could help sentiment further. However, in coming weeks, we think that this optimism could be tested. Now, next week, we will start to see some partial reopening in US states and in the likes of Spain and Italy on Monday. That will provide an early litmus test of the feasibility of economic recovery potential while strict social distancing measures remain in place. We also get a range of US economic data, including manufacturing and non-manufacturing PMIs, plus the key non-farm payroll report for the month of April will be released at the end of next week. Here in Australia, with final March retail sales plus Q1 data, final March merchandise trade data, and the RBA releases its policy statement on Tuesday, plus a statement on monetary policy on Friday too. Westpac's chief economist Bill Evans is forecasting no change in rates until 2023. So what the RBA says will be more important, especially if the RBA does note that the Australian dollar on a trade-weighted basis is now above levels prevailing before the first rate cut at the beginning of March. These are all factors we'll talk about in next week's Markets Update.